Welcome to CRISIL TV. Britain's decision to opt out of European Union has added to the volatility, fragility and uncertainty prevailing in the global economy. To discuss its implications for India, I am joined by Prasad Koparkar, Senior Director at CRISIL Research. The developments in Brexit will have implications for India as well, though at this juncture we do not believe that the overall economy will be impacted in any significant manner. We expect GDP to grow at 7.9%, which was our earlier forecast, because GDP will be driven primarily by domestic factors and monsoons being one of them, which is playing out reasonably well as of now. Then as far as inflation is concerned, we retain our forecast of 5% because the global developments will have benign impact on inflation. Good monsoons will ensure lower food prices, and the weakness in the global economy will ensure that the oil and commodity prices will remain lower for longer. Then I think once the inflation softens, there is possibility of another rate cut. Not only from the inflation front, even from the global side, what we observe is that most of the central banks will be focused on pumping liquidity into the system. That will ensure that global interest rates also remain very low. So I think in this environment, there is room for central bank to cut interest rates by another 25 basis points. And coming to currency, it's generally very difficult to take a call on the currency, but under the current situation, our best assessment is that rupee will remain fairly stable because Indian macros sooner or later will start asserting themselves, and we have a strong pull factor, and we'll see capital coming back to India. So rupee will remain reasonably stable and end the fiscal year 2017 with a value of rupees 66.5 to the dollar. Well, I think while we say that the macroeconomy will not be impacted much, but I think it's not correct to paint all the sectors in the economy with the same brush. There are pockets where I think weakness will transmit from the Eurozone, and to talk about which sectors get impacted, let me come back to you, Prasad.
You're right, DK. I think, while overall UK doesn't account for a large amount of export, only 3% of India's export go there, and about 6% of service export. I think there are clearly sectors which are fairly reliant on UK and Europe. For example, if you look at textile, Europe is the largest area, accounting for about 35% of our export. If you look at auto ancillaries, for example, again, more than 25% of auto ancillary exports go to Europe. And similarly in IT, in the services side, close to 25 to 30% of our exports are again targeted towards UK and Europe. So there will be impact on some of these sectors.
But I think what are the channels of transmission for the weakness in UK, Eurozone and rest of the economy to transmit into these segments?
Yes, I think that's a very valid question. There are 3 or 4 ways we believe that companies in various sectors will get impacted. I think the first and foremost, and which probably will be the most immediate impact, will be through the currency, which we've already seen. I mean, the pound has depreciated by about 10%, euro has depreciated by about 2% versus Indian rupee. That will have an immediate impact on the companies which are exposed there. The other impact is coming through the commodities. With the global uncertainty, we have seen metals, oil taking a beating, and prices have come down. The third impact will come through a slowdown in Europe, which you mentioned. So exports will volumes will get impacted. And the last impact will come through, production centers that Indian companies have set up over a period of time by acquiring units or setting up their own facilities in UK. So once UK breaks out, how the entire trade negotiations and tariff barriers come in will have a significant impact on companies which have facilities in Europe or UK.
Now let's talk about some specific sectors. ITS is one of the very prominent sectors, very visible sectors in India, and it does have presence in UK as well as in Eurozone. So how does it change the game for ITS?
You're right. I think if you look at ITS, on an overall basis, close to about 29% of the exports are to Eurozone, and UK itself is close to about 17%. And if you look at the biggies, clearly for many of them, the exposure is in the range of 20 to 30%. I think the only exception is Infosys, which has relatively, I think, around 15% exposure. And there, I think the impact will again, starting with the currency, immediate impact in terms of, the depreciation impacting the numbers maybe from next quarter itself. But I think the longer term impacts will come through the volume. So the discretionary spend on the IT will definitely get impacted once there is uncertainty, there is slowdown in macroeconomic growth. And one more impact that we really see is through the administrative channel. because there might be more protectionist measures, visa policies might become more difficult, so expenses will go up. And currently also many companies operate out of Europe through their London office. Now if London breaks out and there are trade barriers, many of them will also have to open offices in Europe, so that can further add to the cost.
And I think now, coming to the sector which has been one of the rising stars of Indian manufacturing story, which is the auto sector, and within that particularly the auto component segment, which again has exposure to these economies. So how is the auto sector going to cope with all this? What are the risks that they run?
That's right. I think a lot of Indian auto companies have explored the Euro market very successfully, I must say. For example, if you look at the total auto ancillary exports, close to about 25 to 30% of exports go there. And people are supplying largely to the OEM market. And I think one of the positive thing there is that to get an approval from an OEM, it takes years. So it's not a very easily. So the switching cannot be very easy. So to that extent, I think there will be some stability. But we believe that over a period of time, if the economy slows down and auto volumes in either Eurozone or UK come down, to that extent there will be an impact. And the second factor which I said, there are companies which have significant facilities in Europe, and their exports to Europe today are going without any trade barrier, without any custom duty. So if those barriers come in, and if UK is not able to negotiate a very, very sweet deal with the EU, then there will be an impact on those companies as well.
Then I think finally, one of the major challenges in the economy has been generating employment, and textiles has been, the garment sector has been one of the key employment generators in the economy. It's labor intensive. Now the sector is not doing great. We already seen Vietnam and countries like Bangladesh snatching away the export market from us. Now this will add further to that pain, to some the slowing down of UK and Europe, because it's probably a large garment market, and I think India has a significant exposure to that. So how does the Brexit add to the pain of the garment sector in India?
I think you're right. I think the impact on the garment sector in particular within textile is going to be significant. 35% of our export go there. And as you rightly mentioned, we have already seen, competition from low-cost players like Bangladesh and Vietnam. For example, last year itself, even before this, our exports to Europe declined by 4.5%. So we see tough times going ahead with currency depreciation, with volume growth slowing down. There will definitely be an impact. I think the only saving grace will be that we are operating at in terms of the product range, we are at a slightly premium range compared to Bangladesh. So to that extent, there might be some saving. But overall, we believe that textile, especially the garment sector, will see some pain.
So clearly, Prasad, while the overall economy seems to be reasonably insulated, there are pockets of weaknesses in the economy, and the policymakers should be watching out for developments in the Eurozone and taking steps to cushion ourselves even more. I think textile policy probably will help us a little bit, but not completely. And so I think there is no reason for complacency at this juncture. That's all for today, and thank you very much for watching CRISIL TV.